Cash flow statement will be explained in several parts. Follow the channel to receive all parts. Let's start. Why the cash flow statement is required. The accounting profession realizes that reading only one or two financial statements is not sufficient for understanding a company's finances and operations. Accordingly, the generally accepted accounting principles, GAAP, US GAAP, require that the statement of cash flows be part of a set of financial statements distributed outside of a company. A complete set of financial statements consists of 5 financial statements and the notes to the financial statements. Income statement. Statement of comprehensive income. Balance sheet. Statement of stockholders' equity. Statement of cash flows. Notes to the financial statements. While the income statement amounts make the news, the amounts are based on the accrual basis of accounting. This method of accounting best measures a company's sales, expenses, and earnings during a short time interval. However, the income statement does not measure and report the amounts of cash that flowed in and out of the company. For example, the income statement does not report the following. Cash collected from sales. The cash might be collected from customers 45 days after the sale. Cash paid for goods sold. Payment may have been made many months prior to their sale. Cash paid for buildings and equipment that will be expensed over the next 5 to 30 years. Cash received from the sale of long-term assets. Cash received from bank loans. Cash payments to reduce a loan's principal balance. Cash withdrawn by owners or cash dividends paid to stockholders. A company's understanding of its cash inflows and outflows is critical for meeting its short-term and long-term obligations to its suppliers, employees, and lenders. Current and potential lenders and investors are also interested in the company's cash flows. Financial analysts will review closely the first section of the cash flow statement, cash flows from operating activities. Part of the review consists of comparing this section's total, described as net cash provided by operating activities, to the company's net income. This is done to see whether the revenues, expenses, and net income reported on the income statement are consistent with the change in the company's cash balance. If they are not consistent, they will seek to uncover the root causes for the differences. Perhaps the company's inventory is no longer in demand or is being returned by customers. Perhaps receivables are not being collected, and so on. In short, the analyst believes that cash is king. While there can be some leeway in applying accounting principles, there is no leeway when it comes to reporting the amount of cash. Example of a cash flow statement. The heading for example corporation's statement of cash flows indicates that the amounts occurred during the year January 1st through December 31st, 2022. In bold font you see subheadings for the 3 sections of the SCF. Many corporations omit cash flows from and simply show the following as the subheadings. Operating activities. Investing activities. Financing activities. Some amounts are shown in parentheses, while other amounts are not. We will cover these in detail later, but let's introduce the technique by looking at the amounts shown for investing activities. The amount, $300,000, communicates that cash of $300,000 was paid out, was a cash outflow, or that it reduced the company's cash balance. Parentheses can also be thought of as having a negative or unfavorable effect on the company's cash balance. The amount $40,000 indicates that cash of $40,000 was received, was a cash inflow, or that it increased the company's cash balance. Amounts without parentheses can also be thought of as having a positive or favorable effect on the company's cash balance. The $260,000 is described as the net cash used for investing activities. Net means the combination of the cash outflow of $300,000 and the cash inflow of $40,000. The amount $92,000 shown on the line net increase in cash during the year is the combination of each section's sum, $262,000 plus $260,000 plus $90,000. Since this net amount or grand total is a positive amount, it is shown without parentheses and is described as net increase in cash during the year. Note that the net increase, or net decrease, in cash during the year is combined with the cash at the beginning of the year to show the cash at the end of the year. In our example, it is $92,000 plus $101,000 equals $193,000. The end-of-the-year balance of $193,000 should agree with the cash balance on the company's balance sheet for December 31, 2022. Lastly, at the bottom of all financial statements is a sentence that informs the reader to read the notes to the financial statements. The reason is that not all business transactions can be adequately expressed as amounts on the face of the financial statements.